Is there any point at which your stock would rise to the point where you might split the stock?
Surprise, surprise. I think I'll let Charlie answer that this year.
What is a stock split and why do companies do it? In simple terms, a stock split is breaking a company's existing shares into multiple new shares, but keeping the overall share price the same. There are no set guidelines for how frequently a stock split can happen. Traditionally, though, they've been used to create value for shareholders, though the exact use of a split varies case by case. A company's board of directors will decide to do a stock split and then notify the SEC a minimum of 10 days before the split. Now, it essentially works this way. There's a company with a stock price of $50 each. Then they decide to do a 5-for-1 stock split. That means that there will be 5 slices worth $10 each, yet the overall price is still $50. In March 2022, Amazon announced a 20-for-1 stock split, and the tech giant is no stranger to splits. During the dot-com bubble, Amazon split its stock 3 different times. But investors have other options if they're not interested in a stock split. For example, there are fractional shares, which as the term suggests is buying only a part of a whole share. There are also, of course, ETFs, index funds, etc. They basically are a basket of stocks and bonds. So then why does a stock split matter from a company's perspective? Some argue stock splits can increase liquidity by allowing smaller shares to be bought, sold, and converted to cash more easily. Additionally, a stock split often signals the prosperity of a company. A stock split could get the company involved in major indices and will have a direct impact on ETFs, mutual funds, and other investor funds. For example, in 2014, Apple performed a 7-to-1 stock split, dropping the stock price to $90 from $650, helping it to secure a spot in the Dow Jones Industrial Average. Just because a company's stock price is high does not mean that they need to perform a stock split, however. Legendary investor Warren Buffett's Berkshire Hathaway is the prime example of this. Despite Berkshire's 6-figure stock price, Buffett is firmly against stock splits. He believes that this high price will attract investors interested in the long-term growth. However, that doesn't always hold true for Berkshire Hathaway's Class B shares. In fact, in January 2010, the Class B shares did a 50-to-1 split share. A stock split doesn't fundamentally change value, but it could be an essential step to draw in more investors. Plus, the announcement of a stock split often creates news and makes headlines, upping the company's exposure, of course. This abundance of options has left many wondering if stock splits still have the same impact in modern investing that they used to.